my understanding is, I think last time we covered all the multifamily concepts, everything. Now we want to look at a real case study of one of the 7 properties that we are currently managing and operating. So what you will see today is what we presented to to our investors at the time during the acquisition time. And during that, we can also cover how it's performing and so on, during the respective slides. We will also mention, how things are progressing. Okay. This particular property is in San Antonio.
Mm-hmm.
So it's 204 units. It's a Class B asset that we call. So there are 2 types. I may have mentioned it to you, so when it comes to class of multifamily, one is based on their age, when they are built and so on, and then the other one is the neighborhood in which this particular asset is located in, based on the median household income. It so happens this particular asset, it's classified B in both aspects. So what we will do is we'll go through as if we are presenting it to our potential investors, and exactly how, when we get a new deal like this, which we are currently pursuing, a few assets in San Antonio, some in Florida, we're working through it. Nothing under contract yet, but we should have something soon, in the next few weeks or so. Okay. When we get that, we will be presenting exactly in this fashion. So typically it's Gijo that talks through the initial sections, the overall piece, the market, and so on. Then Srikanth covers the asset itself, and then I cover the financials. Gijo, you want to take over and then start the initial section?
Yeah, sure. Sure. Yeah. So last time I think the introduction all happened, right? So we 3 are working on this. This is the standard presentation. So what you see, I know it's an eye chart, but basically this is a legal disclaimer that our legal team wants us to show you. The highlight of this is, obviously this investment offering is subject to significant risks. And obviously, the investors are encouraged to consult with the financial advisors about their personal financial scenario, and then make the right decisions, right? And then in the presentation, you will also see some forward-looking statements and some of the predictions, some of the data analysis, and we have the industry providers gives us the numbers, and then we make some predictions around it, and so we wanted to make that particular statement. And then it also talks about the sponsors. We don't make any representations or warranties. Obviously, we will have financial projections and things like that. So it's any business has got its own risk, right? So each one of you are requested to do your own analysis in addition to our recommendations. So let's go to the next slide. So this is kind of the essence of this presentation. So I will take you through some of the highlights, the investment summary of this property. We will kind of, even though we got some of the introduction done, we'll kind of repeat for the benefit of everybody and for the benefit of the folks who will be listening to this video. We will also talk about some of the business partners. So it is not that 3 of us are doing this alone, right? We have established a very serious business relationship with a bunch of business partners. We will just tell you who they are and what we do with them. We will also talk about the market that this particular property is, and why we are selecting that particular location in consideration to other areas, right? In the real estate business, you might have heard this. It's always about location. So there is a real strategic reason why we have picked up San Antonio. And it is not only this particular property that we have. Since we purchased this 550, we have purchased another one. We are actively looking into some of the additional new properties. So we'll talk about that submarket. We will get into the property details. We will take you through the comparison of rent among the similar properties. We have a solid business strategy plan, business execution plan, how to raise the rent, how to reduce the expenses, how to collect other income in addition to rent, how to increase the net operating income and things like that. And then we will have, Kamal really taking us through the financials of this. We will look at the current rent, all the financial numbers, expenses, pro forma. We will look at the lender aspects of it, and then we'll take you through the actual process, how to subscribe into this process. And then we will spend almost like 30 minutes at the end for a question and answer session. So why don't we let us roll into the meat, right? So I just want to spend a few minutes on each one of these items, right? So the entire summary, you can see it in this slide. So there are multiple aspects of this real estate investment in terms of the returns, right? One of the benefit is the cash flow. So we are projecting around 8% projected annualized cash on cash, right? And interestingly, this is a case study we are doing. The property has been already purchased, and we have already distributed our first distribution already to our investors. Right after normally we buy the property, we let the property stabilize. It may take between 3 to 6 months minimum, and then we will start the distribution. But interestingly, this property it was such a home run for us. We bought the property in the month of July. I think it was July 19th, if I remember correctly, last year. And then September, October, November, right? August, September, October. I think the first 3 months, we were able to give the distribution very soon, right? Very soon. So literally that stabilization period was very short for this particular investment. So that is very rare to happen, but we are lucky that 550 apartments we were able to do it. People take 6 months to 9 months for stabilizing. So that is one of the attributes that the selection went very well, was the location. The second one is the 120% projected 5-year total return. So this is kind of the considering a whole period of 5 years, right? We may be able to exit the property before 3 years if we meet this projected. This is again a kind of a projections, right? So we kind of expect it will take almost like 3 years to establish the rent growth, and then we stabilize the property, we run it effectively, and then 4th year, 5th year, get ready to exit. And at the end of the 5th year, maybe that's a in this current market situation, we definitely think it can be done much sooner than that. Then comes this projected IRR, right? The internal rate of return. So basically this it is the percentage, the rate earned on each dollar invested for each period it is invested, right? So this kind of gives you a comparative measure, right? Compared to the alternate investments that you make it in the stock market or precious jewelries or metal or whatever, right? So 18.45 IRR is a solid investment return, right? In the general analysis. 80-20 LP-GP split. Those who are not familiar with this, LP stands for limited partner, GP stands for general partner. So the general partner is responsible for the management of the partnership, and the general partner is responsible for the acquisition, the working with the lenders, working with the property management company, overseeing what the property management folks are doing, carrying out the asset management, implementing the business plan, implementing the capital improvements, and finally the whole disposition also, right? The whole life cycle of this property, it is general partner's responsibility. And then the limited partners, of course, they have very less responsibility. Typically they just look at the deal, they analyze the deal, they put their money, and that's it. We don't go back to the limited partners generally asking for money or anything like that, right? It's just a one-time analysis, and there is absolutely no risk. They don't sign any loan. They don't, they just invest the money and watch and enjoy the returns, right? And then monthly, of course, the updates are given to the limited partners and things like that. The second row, if you look at it, 204 units, just a comment that, from an economies of scale perspective, it is an important factor. So for example, we don't really go and look at properties with the units lesser than 60 units. The reason is that, it will not be viable for us to run it using a professional property management company, right? So the number of units is definitely a good consideration, right? Then the common expenses can be shared across these numbers if it is a more number of units and things like that. It is built in 1984, which is a kind of a decent number, right? We generally don't get excited if the property is built, in 1970s or before, right? When we took over the property, it was 95% physical occupancy. That was a good number. The other one is the 85% loan to cost, the bridge loan, right? So one of the very good thing that happened with this property was we were able to get a very good loan leverage, right? 85% and exact numbers, this is again, when the presentation was made, and then, obviously when we work with the lenders, the numbers keep changing, right? A little bit here and there, but I don't remember exactly how much the final loan terms are. But the good news is that, we were able to get a very good leverage on this one. And even the interest rate now, kind of looking back 6 months, 9 months, oh my God, this is one of the best deals, right? Anyway, 22.75 was the purchase price, as you see on the screen. We have $900,000 we established initially for the rehab, the capex projects, and we'll talk. Srikanth will take you through the business plan. Where are we planning to invest? So, by the way, we upfront decide what to do, right? It's not like, we buy the property and then we figure out, oh my God, now I need $2 million to do capex improvements. No, we plan out all that before acquiring the property. And technically speaking, no surprises, right? Because we do that much due diligence before we sign up before we close the deal. So we bring in a third-party property management company or a due diligence company. We pay money, and it's worth it. They do a thorough due diligence to establish, and so upfront we know how much is our additional investment in other than the purchase price, right? Now the minimum investment 50,000. Yeah, we kind of vary between. On an average, I've seen among the hundreds of investors we have, they kind of trend towards investing 100,000. That's kind of a good number, but we do take 50,000, 75,000, and things like that. The reason why we kept this 50,000 as minimum, because as a syndication group, we incur administrative cost, right? So every investor, we have to file with the state government, about the details, the SEC filing, we call it, the Security Exchange Commission. So the legal cost, kind of administrative cost, kind of goes up. So up to $4 million is the equity raise that, we talked about the loan to cost and all that. So let's go to the next slide. So the business part, I think, So this is again, I don't want to kind of take away a lot of your time on the sponsors. In our last meeting, we all introduced ourselves, right? So I think one of the biggest thing that I want to call it out here is that, this particular group here, three of us, I truly believe we know the game, right? What we are trying to do here. We all are coming from engineering background, and we are extremely talented, very focused on data. We spend a lot of time and energy in analyzing the data. We read about the data reports, and we have specialized agencies providing the data. So we think that we three are kind of complementing the skills. And again, why I'm calling it out is that this is a big deal, right? What drives a great investment opportunity? Definitely, I would say the sponsoring team first. And if the sponsoring team works in a very well-oiled machine, that I truly think we are during the last almost like 3 years, we're working together and in various capacities, and we think that we are we kind of for the benefit of the investors, for the benefit of everybody, right? We represent them. Now the business partners, it's an extension of us, right? So you see some of these logos here. They are all kind of nationally famous listing brokers like Northmark, and we work with. So this is particular to this particular property. We kind of work with similar leading listing brokers. So, for example, you name Newmark. You may mention the Berkadia. It's they themselves are brokers, and Marcus and Millichap, Northmark, all these Newmark. So all these leading US brands, we already have more than one properties with some of these listing brokers. So we kind of cover the bigger space there, right? Listing brokers they trust us. They come to us with the properties. Now we are kind of moved on, right? We don't run behind them. They kind of run behind us, right? It's a good situation, right? Because they trust us. They know that these deals can happen, right? That's a big thing for brokers. The Trinity Property Management Company, the property management company that we have engaged with for all of our properties, they are also one of the leading property management companies. They have some 20,000 doors in United States, work in different states, approximately 200 apartment complex that they manage. We have a very smart regional manager that she's working with us. So we spend good amount of time strategizing how to reduce the expenses. If you look at the left-hand side, the Premier Law Group, they are like, we have two attorneys working for us, right? One is the real estate transactional attorney. Another one is, what is that called? SEC specialized attorney. Bethany is the SEC specialized attorney, and Carrie is the real estate transactional attorney. Both of them doing a phenomenal job from a legal perspective, protecting investors' interest, protecting sponsors' interest, and making sure that we are covered all from a regulatory perspective, right? Madison Specs, cost segregation agency. They are one of the nationally well-known for the cost. They're called as the cost segregation experts in the country, right? We have engaged. They make sure that maximum leverage is received. Syndication Pro is a software that we use for subscription processes. SAS is the water conservation. Berkadia, of course, this particular project, they helped us to establish the loan. They are the loan originators. So we work with the business. So the key here is repeat, and repeat, right? We establish a team, not only as an expanded team with the third-party service providers, and we pay the money. We have to pay their fees, right? It's a good amount of money we pay, but in return, we get their trust, relationship, and the quality of work. And we do that in one project. Exactly, we just replicate the same thing for the next project, right? We kind of so Premier Law Group, last three, all the properties, they have been the early attorneys. Trinity Property Management, same property management company, we keep using it again and again. So we just believe in that scalability and reputation, right? I think that's the key of for our business success. Moving on to the market and location. So if you go to the next slide. So San Antonio, I told you, this is one of our favorite. We are so pleased and lucky that we were able to establish the business in San Antonio. So those who are not familiar with Texas, we have a corridor between Austin and San Antonio, and we three of us, we travel on that corridor very frequently. And what we see is that there is absolutely it's a continuous developments happening all the way from Austin to Austin is one of the kind of a what do you want to call it? California, the San Francisco type of environment going there, and things are a lot many. Any you name a leading employer in the company in the United States or in the world, they have an Austin presence, right? So it is one of the most sought after city in United States, and then that Austin effect, right? It is continuing through the entire corridor all the way up to San Antonio, right? So as you see there, this is the seventh largest city in the United States, San Antonio, and within Texas, it is the second largest city. There are a lot of developments happening. So, and it's a proven fact, right? In the 550, we thought about it, we bought the property, and look at it. Look at the tenant profile in this San Antonio. Our delinquency is so low in this property because the location is great. There are a lot of tenants, good tenants, right? Living in that market, working there, and staying in our properties, and So good news about San Antonio. You can read through it. I don't have to keep talking about this employee, San Antonio greatness. You look at major employers, as you see on the screen. You name an industry, there is a presence in uh, San Antonio. One of their biggest defense establishments are, one of the biggest insurance companies headquarters, and HEB, one of the grocery shop headquarters. So there are so many employees in that space. Let's go to the next slide. I think it is a few more slides are kind of talking about. I want to kind of take you to the more essence on the property. So we'll kind of so this is maybe a good thing. It's only 9 miles from the San Antonio airport. This we are talking about. So look at the bigger interest. USA headquarters is just 15 miles away, right? You know that's one of the big insurance company working for the defense people. Universities are there, and then AT&T Center, and all that good stuff. So great location. We want to do more and more properties in that area. See, look at the aerial view of it. It is such a good thing to see, right? Where this property is located, right in the main area. You have all these grocery shops, home improvement shops, all nearby, right? As you see on the cursor, it's a great location. Just the good news is that we kind of went in the same mode. We were able to close another property called Villas di Sendero, right? That is one of another property we closed in December. This was closed in July, and another one we closed in December. I'm sure in this year also we will have some additional properties in San Antonio. It has been a great ride in San Antonio. Demographics, right? So just to give you some ideas about how do we select these locations, right? We look at the population growth. We look at the employers interest in that area. We look at the crime rate. We look at the median household income. So it is so important, right? The median. So look at the median household income at the 1 mile radius. It's around 65,963. 3 mile radius, it is 62, and 5 miles. So it's all about 60. Now this is actually July data, right? It's almost like 9 months old data. If you take today's median household income, San Antonio has already gone up much more than this, right? So that's an interesting thing. Median home value, definitely that has gone up, definitely by maybe 25% to 30% easily, right? So these are all the demographics that we look at while selecting the location. Let's go to the next slide. So at this point, let me hand it over to Srikanth, who will take us through some of the attributes of the property.
Yeah, thanks, Jijo. So as a part of this presentation, normally we go through some property details, what type of facilities we have, what amenities we have, what's the unit mix look like, and then we walk through the business plan. So let's go to the next slide. So if you look at this gives a snapshot of the quick facts of the property. So the property address and what county it resides in, because people can look at the county tax data and information. If you're doing some diligence around, you want to invest or not, what's the county look like, what's the population look like. So you could research on the Bexar County here and then get some stats. And then the typical things which Jijo covered before: 204 units, 95% occupied. And it talks about the garden style variety of apartment. It's not like high rise, it's more garden style laid out across different acres of the land. And then the parking spots is important too when we look at the property, because most of the times we would like to take 1:2 ratio for the parking spots. So if there are 100 units, at least 1.5 times the number of units should be the parking availability, because a lot of people have 2 cars at least, right? So that's the reason why we look at the parking spaces available. And also we want to earn some other income. I'll cover that one in a bit. So if you have more number of parking spots, we can put covered parking and get some more income. So let's go to the next slide. So this kind of gives you the, we try to visualize how the property looks for our investors, right? So we want to take pictures and show them, so that it gives an idea what they're investing in, because you don't even buy things without looking. So this is a way of showing the investors how do we really present the property. So we take pictures which are very key, because like the leasing office is one of them. So how is the leasing office looks like? How would the amenities look like? Like here's a swimming pool picture, and then we have the barbecue areas where the property has. So we look for those kind of amenities and try to take some pictures and show it to the investors so they have a good idea about how the property is. So we also took a picture about what's the night view of it. This one has a very specific neon lighting. I think this is one of the nicer properties in the area where this is the only one which has a neon lighting actually in the night. So we drove by and we took a picture of it. So this is all some small things which we put effort while we're acquiring the property, so that we can show all this to our investors. Again, these are some of the reviews of the leasing office and the other areas. We have a barbecue pit, and then we have swimming pool area. So these are some good pictures we took at that time. And we also try to give an interior picture, how things are, how things look when we have a standard units and we have like upgraded units. So we try to basically see if we upgrade the units, this is the quality of upgrades we want to provide for our tenants, so that we can increase our net operating income by charging $100 to $200 more for each upgrade we do. So if you look at this, we have stainless steel appliances, and then we have quads or granite countertops, and then we have white cabinets. So there's a difference in white cabinets and regular cabinets. So the modern contemporary look you have in the unit, the more upper rent charges you can collect. So next slide. Again, more pictures of it. I think this one has a dog park here. You can see in the center. And we also see if there's a gym, then we try to take pictures of the gym. As usual, we want to give all the amenities and give a look of all the amenities for the investors. Keep going. So unit mix is very important. Whenever we're doing some analysis on the property while acquiring, we look for properties which have good variety of unit mixes, because we want to play with the numbers. We want to figure out, we need to have the flexibility for us to upgrade certain units and not upgrade certain units based on the rents we're collecting. So if you have more number of unit mixes, like 1 bedroom, 1.5, 2 bedroom, 2 bath, 2 bedroom, 2.5 baths, it's good for us because we can play around with the rent comps and then also upgrade units. Some 1 bedrooms need not be upgraded, maybe only 2 bedrooms you want to upgrade. So that's something which we look for when we're acquiring the property. Next slide. So we look at the rental comps. So in this specific case, I think 550 apartments was sitting at the markets way below the rents. I think they were collecting. The average rent was about $940. Some unit mixes they collect rents which are higher, but some unit mixes they're lower. So we try to look for that balance on what's the opportunity for us to raise rents. So from the time we purchased from till today, actually within less than a year, I think we almost had the opportunity to raise about 9.5% rent for this property. So even though we conservatively estimated the rent growth, we were able to actually do about 9 to 10% close to for this specific property. And then we also look at what properties in the same age group and the year, so from 1980s and then around the same size. If you say around 200 to 225 to 250 units, take those units nearby property within 1 to 3 miles radius, and let's see how they are rented, right? Where are we sitting in the rental comps, and see what's the margin we have, and then we'll estimate our projections regarding that. So if you look at this one, if you look at 1 bedroom is sitting at the somewhere bottom half of the page, right? So this kind of gives you an idea how much room do we have to increase the rents for 550 itself. So this is where we do the analysis. Next page. This is 2 bedrooms. Where do we sit, right? So 2 bedrooms are probably here, I think around 1075. We can probably raise to 1171. So we already have about $100 less they're paying. So we look at that data too. All right. So this is the key slide, right? This is where I think the whole investment comes into play. So the reason why we acquire properties and the way we manage the property so that we can raise the rents, we can implement the business plan. How do we really increase the value of the property is very important. So these are the steps we plan to take for this property for by increasing the value. One is just plain upgrading of the unit. So we did about we wanted to do about 90 units of upgrade. So this is the capex for just interior upgrade. So each unit will cost us to upgrade anywhere from $6,000 to $8,000 per unit. So we allocated a budget for about 90 units for upgrading. Then we said, okay, let's bring in a media package because tenants are paying individually for every cable and TV. Right? It's now nowadays nobody uses TV, so more a cable package, I would say, right, like an internet service package. Then we negotiate with the ISP providers and provide a bulk rate so that we can save some costs and then get some dollars back for the property itself. That's one way to do it. We estimated some value in that. Of course, implementing the reserved parking. If I'm not mistaken, we probably talked about implementing at least 30 reserved parking and charge about $30. And then that kind of multiplies 30 times 12. And at a significant cap rate of 4.5, it increases the value to a certain extent. So that's how we calculate the value. And then reserved parking and then covered parking, there are two different things. Reserved is actually very easy to implement. You just do is put a paint sign say reserve, and there's nothing else to be done, which is close to the unit. And then the tenants basically are happy to pay because they don't have to walk too long. So covered parking needs some capex. We estimate about $1,000 to $1,200 of capex for putting all the carports and making some markers around the fire lanes and everything. Extended backyards is another concept where some of the units have open space to the yard and the lawn space. So we try to put a fence around it. It doesn't take much cost, just to enlarge the patio area and put a large fence and a small door, like a picket, not more picket fence, more like a wooded fence, and so that they have like a private feeling around their own backyard. And we can easily charge about $30. So we estimated about 15 of those units have the potential for extending those backyards. So that's another plan we thought. Storage is another one which we said that specific area has a lot of trails and creeks. And what we found out from the market surveys, the tenants are very active in terms of lifestyle. So they wanted some space for putting their bikes and other stuff, and canoes or whatever, right? So we said, okay, we can probably have some storage sheds and then charge some money. So that's one of the ideas which we had. And there are a few other things like valet trash, washer dryer rentals, and Amazon locker box. So with all these things, business plan, and we execute, we estimate about $170,000 over a period of 3 years. That's in addition to the 90 units upgrade. So total value creation is about $3.4 million for the time we hold the property for 3 to 5 years. That was the estimated value creation. Next slide. All right, this is where Kamal takes over and goes to the numbers. So
yeah, thank you, Srikanth. So let me jump into the numbers here. So the total transaction amount that's involved here is roughly 24,750,000, close to $25 million, in which we raised $4 million approximately, and then the remaining amount is the loan, which is used for the down payment, and then we always keep some amount as a reserve for working capital. And then we estimated approximately about $900,000. That's for upgrading units, doing internal and external any rehabilitation that we have to do by enhancing the look. and increase in the value of the stuff that Srikanth has walked through the business plan. So that's this $892,000. Then the closing costs is about $772,000, and then the detailed breakdown of the closing costs is shown here, which includes the detailed inspection, the legal fees, the lender attorney fees. The bank has its own fees. Then the acquisition fee. This is something the sponsors take. It's 1% of the purchase price of the asset, excluding the closing costs and other things. And then there is because interest rates could be going higher, there is a mandatory cap purchase, what we call interest rate cap, that will help us, if it goes above that, we're always protected, that you don't end up paying higher mortgage payments for the interest. So we bought that at a 1% strike rate, which is good. I think we got interest rate roughly, I think if I remember correct, 4.5%. So we are covered until 5.5%. Anything beyond that, we don't have to worry about it. Automatically, this cap rate provider would take care of that stuff. So in total, it's roughly about 3.4% of the total purchase price is the closing costs, and this is the detailed breakdown of both the sources as well as the uses. And this is a quick snapshot of if there is a limited partner and if they invest money, how can you see the returns? As you can see, the returns are broken down into two components. First one is the cash flow, which the investors receive on a quarterly basis, estimated at about 8% per year. We are pretty much on the dot in paying this amount of cash flow for this property. And then the remaining piece is when we sell it, we typically hold it for 5 years and sell it. When we sell it, then there is an equity improvement. When we implement our business plan and then maintain the property well, then automatically the value would go up, and then we expect to get higher sale price. So when we the total return is about 120%, which includes 8% for the cash flow per year. For 5 years, 8 multiplied by 5, 40% is related to cash flow. And then the remaining 80% is when we sell it, they would get that much, which translate to, if you take the 120% total divide by 5, that's roughly 24% annualized return. And then the IRR, the financial metric, equates to about 18.79% internal rate of return. To put it simply, if somebody invests, let's say $100,000 as a limited partner, they would get $40,000 over a period of 5 years at $8,000 each year. That's the $40,000. And then when we sell it, you'll get an additional $80,000 at the end of 5 years on top of your original investment. So if you put 100K, you will end up getting $220,000 in total along with your capital back. So that's in a net. And then obviously it will be proportional if you invest more or less. We showed a few more scenarios, 50,000 and 75,000. For a simple limited partner, they just want to understand the numbers. This is the way to look at it. There is this other concept. This is particularly, I think we talked about this before. This is the depreciation loss. And especially in this asset class in multifamily, this is a huge benefit, and this is a very unique benefit for the multifamily. If somebody invests $100,000 in this asset, whoever invested, they were able to get, the final number was about 105%, 104.8 or so. We are able to write off $105,000 in year one. So last year, whoever put 100K, they can write off $100,000. There are certain conditions that apply. So this is where we talked about last time when we talked about the concepts. Some of the Canadian folks, they may not be able to take full advantage of it, but especially the US limited partners, US-based limited partners, they can take advantage of this under certain conditions where one of the spouses can be classified as a real estate professional. It doesn't mean any certification or anything. It just means that they are focused more on real estate work as opposed to any other business. So in most cases, one of the spouses might be a housewife, or could be is focused more around at least 750 hours is what is required to be categorized into that. And they could say no, they're researching, they're buying and renting homes or whatever. And this, even including investment in this, is considered as will count towards that. So obviously, you can consult any CPAs within the US, they will explain these rules. But this is a huge benefit. As you can see, this itself, for somebody that's in the highest tax bracket, including for the US folks, I can relate, if you can relate to it, it's 43% is the total highest tax bracket, including the Obamacare. So on $100,000, if you're able to write off that much, $43,000 tax deferral in year one itself, that's a hard savings in year one itself, in addition to the 8% return, every year. So a lot of people invest in this asset class simply to take advantage of this benefit. Now let's get into the underwriting. What you're seeing on the screen is the analyzer that we use. This is something that has been developed and enhanced over the past 20 years. And thousands of multifamily acquisitions have used this, and they have enhanced this. As we are understanding more and more, this analyzer has been enhanced. So all three of us have gone through a rigorous training, and there is a group called Brad Sumrock Apartment Mastery. So we paid, each of us paid about $35,000 per year and joined this program and learned this stuff basically. And one of the benefits is getting all the tools and processes that we could use, and we can take it and we can further enhance. So what you're seeing on the screen is that analyzer that has gone through that much amount of real experience, all the assets, through the full life cycle of these acquisitions, and then and then selling it at the end of 5 years. Empirically, they keep changing these parameters within this, so it will clearly show you when you enter all the numbers. It will clearly tell you what is the projected return in terms of the cash flow, in terms of the total return, and so on, which is what we share with our investors, and then we continue to track. So the core things that will go into this, as you can see here, of course, the purchase price, the closing cost estimates that we have done, the interest rates, the loan terms, and so on. And in addition, the detailed pieces are the unit mix. And unit mix, what is the current rent and what is the projected rent. And these projected rents that we compute based on the market analysis. So we have, again, even there, we have subscriptions to industry data where we get that, if we can, Srikanth was showing earlier, the comparable properties. So we get rents of each one of those properties for their unit mixes. We're able to look at that, and then we'll come up with a pro forma over the next 5 years, what would be potential rent increases that we could do, where we are and where we need to go. And if you also notice, there is a green font mix, and then there is a black font mix for these apartment units. The green is the planned upgrades. Roughly, we upgrade about 50% of the units. So that, these are all there's a concept of classic versus upgraded. Classic is something where the way they would exist when we acquire it. And in most cases, they are not upgraded. This being an 84 property, probably last time they did any upgrades, maybe 5-10 years ago. Maybe 10 years ago. So which means they're ready for an upgrade. When we look at it, when we are acquiring this property, it's important because if it is already fully upgraded and we are purchasing it, then we will not have the ability to increase the rents by upgrade, because upgrading it doesn't cost a whole lot. Typically an average upgrade to a stainless steel and all those kind of good stuff somewhere between $6,000 to $10,000, depending on the size of the apartment unit itself. So when you do that, that's all you need to spend, and suddenly you're able to significantly push the rent higher, which means that you are able to get much higher net operating income, which means that you're able to increase the value of the property when you're ready to sell. So when we use this analyzer, we already know how many units we're going to upgrade, which is what it's shown in the green font. And as you can see, they will have higher rents. When we take them, when we upgrade it, we will be expecting higher rents. When we looked at this, as you also saw when Srikanth presented, this particular property, for whatever reason, it was charging much lesser. The main reason was actually the guy was, I think, the single owner, he was managing it by themselves. So they did not have a professional way of looking at it. They did not probably have a good experience, which is why their expenses were higher, their rents were lower. So, which is why we saw an opportunity to significantly increase the rents if you run it properly, which we were able to do it. We were only 9 months into the acquisition. We already raised close to 10% in the rent growth. Like our overall projection was only 16% over 5 years, but like we were able to do that much faster. When we enter all these numbers, you'll see this yellow font. You can expect, this is how it will, the analyzer would tell you, you can expect 8% cash flow, and then like 118.5 to approximately 120% in total return over 5 years. And this is another, in the same analyzer, we also look into this detail over a 5 year. This is also like what we modeled here is the occupancy, like there's a concept of economic vacancy. It's not just a physical vacancy alone. Like there could be subsidies we might give, there might be specials, there might be situations where like people are not paying rents and so on. So you need to account for all those to model it properly, so that like we know exactly what could be the projections. That's where where we have economic vacancy. That's where we enter all these numbers. We also model the increase in expenses and so on year over year on the top, and based on that, we can see how the returns would be computed. There are few key concepts that I want to draw your attention here. First thing is the economic vacancy, which I already talked about. Currently, it's running at about 8 to 7% economic vacancy, but we modeled it conservatively. We assumed year one, we modeled it 13% economic vacancy. It's a conservative way of looking at it. That way, if you can do it better, it's even good. And then after that, year over year, as it stabilizes, the economic vacancy would be going down. Then the second concept is Dscr, like the one that's highlighted in green here. That's the debt service coverage ratio. The lenders expect that number to be more than 1.25. And you can see here, if it's more than 1, that's great, but it's 1.25 is what is the desirable number. When we model it, we can look at after we take over, it's 1.29, 1.44. It always stays higher than 1.25, which shows that this asset can perform really well, and we should not have any issue in producing the returns that we are promising to our investors. The other concept we need to look at is the reversion cap rate. So simply put, it is the capitalization rate that we are using when we exit. When we sell the property at the end of 5 years, we look at the market projections. There is several companies that provide this. One of the things that we use is the CoStar. So they are the industry leader within US for the multifamily. So they have rich data. Almost every property, every apartment unit within US, they have the data for that, and they know the sales data. They have all that kind of good information. So they project the certain things, and we also put some conservativeness to it. And then we put 5.2%. The reality is the cap rates have been going down, which means what the number that we put in here, 5.2, is a conservative number. Even with 5.2, we can produce 120% return. And I'll talk about this in more detail in the next, in the future slide, the concept of the reversion cap rate, and then what are the potential scenarios that would happen, how the returns could be higher or lower. Then this slide is the expenses. As you can see on the left-hand side is the trailing 12 months, how the previous owner was operating. They were operating roughly at about 53% as a ratio of expenses to income. And we tweaked it a little bit, we know that we can do it much better, and which we are doing. Our expenses are much lesser than, we projected, we assume 48% ratio expenses to income. And with that, we have the projected returns, but in reality, we are able to trim down the expenses even more. So this is the thing I was talking about earlier. This is the cap rate sensitivity analysis. The green line shows our pro forma, where we said if we exit at the end of 5 years as planned, you can expect 118.7%, which is rounded to 119% return. So a lot of people ask, what happens if, for whatever reason, you decide to exit in 4th year or 3rd year or 2nd year, at the end of 2nd year or 3rd year or 4th year. And this is what this is showing. If for whatever reason you decide to exit at the end of 4th year, assuming everything else is equal, all other conditions in the market and everything is same, you would be making less money. Basically, the total return is only 98% if it's the end of the 4th year. And similarly, you can see the other numbers here. This is at the cap rate of 5.2%, reversion cap rate of 5.2%. What happens if the cap rates go lower, which is where the markets are headed? Right now, for this property, it's at about 4%. And it's continuing to go down. Probably, most likely, it's going to stabilize at about 4% flat for the next 5 years or so. If it's at 4%, that's the orange line on the top. If we exit at the end of 5 years, we're actually making 298%, close to 300%. So the numbers that we said, that 120% total return, that is just a projection. If the deal ends up doing more, obviously the limited partners and the general partners will be making a lot more money. So there are no caps to this. You would end up making a lot higher. That's what this chart is showing. In fact, we could exit even at the end of 2nd year, and we can still be making much more than what we promised at the end of 5 years. Because current purchase cap rates are around 4% right now. And then the other scenarios, as you can see, the yellow line shows the cap rate of 4.5. What happens if the cap rates go up, which is completely unlikely scenario, but we're just illustrating. That's the blue line. If the cap rates go up, and then if we decide to exit for whatever reason, then our returns will be significantly lower. That's what this is showing, right? But what happens is if for whatever reason the conditions are not good, we typically hold and wait, because it's still an income generating asset, so we don't have to worry about it. You hold on to it, and then the market conditions are right, and then you sell it. A quick view on how the deal is structured. So as we already mentioned, there are general partners and limited partners. So another term for general partners is sponsors. Another term for limited partners is the regular investors. So every dollar the deal makes, 80 cents goes towards the limited partners and 20 cents goes to the general partners. So that's this 80%, 20% profit split. Property management, we typically pay 3% of the gross revenue. So they charge every month, whatever is the gross revenue, they take 3% to manage the property. And the strategy and the whole mechanism we provide to them, which to the property management company, and then they execute it. For us to oversee and then help implement the business plan as well as provide the strategy to the property management. The sponsor team, the general partners, we charge asset management fee. Sometimes we hire a professional asset manager, in which case we pay that person the 2% fee, which is also computed based on the gross revenue that the asset generates every month. The other fees that are involved is the acquisition fee. There's a one-time 1%, which I showed earlier in the closing costs, the sponsors take to go through the entire acquisition process. Typically, our hit rate is about 20%. We look at about 10 properties, you will end up getting probably under contract about 2 of them. Sometimes we end up, even as general partners, we have to put hard money. And then as part of the due diligence, we might decide to walk away because certain things are not looking good as part of the due diligence. Then we end up losing that money. So anyway, there is a risk that we have, that's rational why we charge this acquisition fee, that 1%. A lot of other general partners, they charge these capital events, disposition when they sell, and there are other hidden fees that are there, but we don't do that. This group, we go with this. This is a structure that we follow. And how to invest as a limited partner? There are 3 investment options. You can invest as an individual. You can invest if you have a retirement income accounts. You can invest through them, whether it is IRA or a 401k. These are all the US terms. So I'm assuming there'll be similar terms on the Canadian side. And then if you have partnerships or LLCs, you can join as a group and then come in as an LLC and so on. So all 3 possibilities exist. Typically, the whole process is roughly about 60 days, start to finish. So as you can see here, this particular one, we signed the contract, PSA, we call it Purchase and Sale Agreement. We signed it on April 30th, and we closed it in the first week of July. The due diligence happens very quickly within the first 2 weeks. And that's how we understand, what need to get done, what are the projections, what kind of business plan that we need to implement, what kind of repair and maintenance we have to do after we take over. So we know up to the dollar level, what is involved in this. So we take all, and then if you decide to walk away, that's when we walk away, right? So we have all that information. We bring all that, and then we conduct a webinar like this, and then we start raising the capital. This particular property, and we allow about 2-3 weeks to raise the capital. This particular one, it got funded within 1 weekend, within 3 days. It got we did this on a Wednesday, and then by Friday it was all done. All $4 million was already raised. We ended up we raised a little bit more because some of them came in, there was a ties and stuff. So we ended up raising, I believe, a little bit over 4 million. And then we stopped basically. They saying that we're done. And then we waited for the lending process to complete, and then we closed it as planned. The whole process, it's highly automated, and it's also self-serving. Syndication Pro is the online portal that we use. It's a SaaS software. We use that software, and then we have our own portal called upsideassets.com, upsideassets.investorportal.com. So that's where investors would go. They would first register their profile. In fact, all your investors, even right now, they could go there and then set up a profile, look at that website, and then have the data ready. And then once we have the contract in place and we open up for subscription, you would go there, and then the profile would automatically flow in. So it's all DocuSign kind of stuff. It's integrated into this portal. You will have to fill in all those data elements, and then you electronically sign. We review it and we approve it. And then once it is done, there are instructions at the end of the subscription process for wiring the money, and then that's it. And subsequent to that, also all the operational elements, whether it is distribution that we're sending it out, any communication, everything is orchestrated through the software, through this portal. You can log in at any point of time and you can look at all your information, your subscription, your signed documents, your tax documents, the investor communications, everything will be captured here. So that's pretty much we had to share. This is how a typical webinar is done for any investment. And then like people ask questions and then we answer them and then we open up the subscription. Usually we do the webinar on the same day we open the subscription. Right after the webinar, people can go and start doing it. Until then, it is hidden. It won't be visible on the portal. Okay, any questions? I think we're done with our presentation here.
Kamilakar, are you also presenting about a project which is not so well that is also there today, or?
No, again, we had one property in Houston where it is slightly underperforming, but we got it back under control. We did not have it. I think everything else is performing really, really well. We did not have any issues. There's only one property. It's the smallest property that we have. It's primarily because it's in a secondary market. Like, it's not, so there's a concept of primary and secondary market. Primary market is right within these hubs, like in Texas, like Houston, Dallas, Austin, San Antonio, very close to the city, like within 20-mile radius, right? Within 20 to 30-mile radius. That's the primary thing. This secondary market is about like, probably 60 to 90-mile radius. These are the suburban, these are like, little bit secondary cities. Port Arthur, Texas, that's where we had this. We had a little bit of issue primarily around the staffing from the property management company. And that made things a little bit worse. But we finally got people that in fact, they loved the place, they relocated and they're staying in the apartment complex. Our leasing staff and our technical staff, they're all staying in the apartments, and then it's back under dormancy right now.
Okay, great. Kamal, I have a few questions actually.
Yeah.
So now, what I understood from there is that you do all the due diligence, you identify the project, and the limited partners basically come after you have signed the contract.
Correct.
So once you have signed the contract, limited partners come on board. Any decisions that are made about the property, will there be any role of limited partners, or they are just silent?
They are silent. That's why they're called passive.
They have no say in whatever is done or whatever is taken. You just invest your money and just go for vacation.
That is correct, pretty much, because this is a complex operation, right?
Mm-hmm.
So multifamily is a complex operation. You need to be highly trained. There are reasons why we make decisions and so on. That's why it's typically not a one-person team. You always see 3 to 4 people that are experienced, right?
Okay.
So
quick comment on that one, right? If you think about you're investing in stock like Microsoft or any other company, right? You're a passive investor pretty much, right? You can take it out.
Yeah.
You have a proxy vote probably when they call for some shareholders meeting, right? Big companies. So this is kind of a small company. You have access to the sponsors. You can talk to the sponsors one-on-one and get insight into how your property is doing and all those details, right?
Okay.
It's the same thing, but it's a passive investors method. Yeah.
Right. Okay. Okay. And for the general partner, is there any capital contribution initially or no?
yes, always. Because like we typically minimum we invest is $100,000 each of us. In some cases, it's a lot higher because each of us sometimes we require higher tax benefit and so on. So in some cases, we have invested $250,000, $300,000 each of us. But minimum is $100,000. And for that, you get Class A shares, what we call, that's limited partner shares. So we are a limited partner and a general partner, basically. General partner is a Class B shares, which you get as part of the asset dilution, that 20/80 kind of stuff.
Right. Okay. And you made a comment that for next few years, the cap rate will be stabilized around 4%. Why do you think so?
That's what the market pundits and market gurus are saying. It will be around 4% is where, because given where things are going headed,
I
right?
see.
Even around, it will hover around 4%. That's what they're saying. They're down
Right.
now, and then they'll probably marginally go up and then stabilize there. That's what they're saying.
I see. I see. And even with the new, increased inflation rates and Russia-Ukraine war, do you see any headwinds in this market there, or what kind of challenge you foresee in your sphere there?
So those are all reflected in the interest rate hikes and those kinds of stuff.
Mhm.
The thing about us is those matter at the time of acquisition, right? So when we acquire it, whatever is interest rate at that point of time, we will be underwriting it based on that, and the numbers have to work for us to move forward, right? The good news is actually the inflation and all that is only going to help, because think about, like, you bought an asset at certain price. Inflation is going to make the dollar cheaper, which means that, like, people, the wages will be higher, the asset values will be higher. Automatically, everything is going up. So we can charge higher rents. The asset, even if you do nothing, the asset value is going to go up, which is actually good when you're selling it, right?
Yeah, but I'm not sure about the wages will go higher, right? So inflation, yes, is there, but it doesn't automatically increase the wages of the people.
Well, yeah, I mean, right now, like in every aspect, if the cost of goods, everything is going up, at least here, that's what we are noticing, basically, at least right now. But anyway, we will have to see that. But again, we look at, it's our experience. We also look at the markets, what they're saying. Like, there is, yeah.
Right. And in your project so far, which you have done, have you had to hold any project beyond 5-year target time frame, or no?
Actually, again, our experience has been only about 3 years. We did not go beyond.
Oh, I see. Okay. All right. Yeah, I think that's all from my side.
Yeah, hi,
Yeah,
Kamal.
and Devinder, yeah.
Yeah, Devinder. Yeah.
So, Kamal, can you just go back 2 slides? One more, please. One more. Yeah. So in this, go back in the fee section. So could you just elaborate a little bit on the asset management fee? I did not understand what is the value asset management fee is providing to the investors.
Yes, asset management is, we have to provide the entire business plan and our strategy and our philosophy to the property management company. What metrics we are looking at, like, what are the projected stuff? How are you going to tune the expenses? We actually tell property management company on a weekly basis. We have calls and we have reports that which is our DNA of success, how we manage our properties, our portfolio, right? We provide all that strategy to property management. That is part of the asset management. The second piece is, you saw the business plan. It had about 10-15 items of all the things that need to get done, like, bringing in, executing that entire capex plan, the business plan. It could be upgrading the units, like, what should be how should the upgraded unit look like? What should be the rental charges that we should be charging for that, right? Like, covered parking, all those kinds of stuff. Like, we have to implement every one of those and then push our achieve our pro forma. That is all part of asset management.
So Kamal, if you are doing all that work, then why are we paying 3% to a property management firm? Because you are doing all the work.
Yeah. So property management is the actual execution, folks. They actually do the work. We tell the thing, strategy, and we tell, like, what need to get done. They will do actual work. And they also run the payroll of the people. Like, we will have, like, for this asset, we have about 4 or 5 people within us. There are like 2 people in the leasing staff, and there are 3 people on the service technicians and all those kinds of stuff, running their payroll, insurance, all the back-end reports, back-end mechanisms. Everything is done by the property management. Hiring of those people, managing all those things. That's actually
what is the annual cost? This 3%. What is the dollar amount?
That will be, again, like it will be proportional to the gross annual income. So in this case, right, you can see here.
Actually, the next slide, Kamal, the expenses slide will be there. The next one.
Talk about the payroll, right? So the payroll is basically the staff members to, leasing agent, technicians. The payroll is estimated around 200,000.
No,
I think he was talking about the property management fee, right?
Yeah, the 3% is roughly about $70,000.
Right. So the payroll of the staff is still charged to the company, right?
Yes,
The
yes.
3% does not cover the payroll, right?
That is correct. Correct.
So basically, 3% is the management fee you're paying somebody to execute the stuff. The expenses are still charged to the group.
That is correct.
That's correct.
Okay. Thank you for that.
$72,000 in this dollar value. You're asking the question earlier.
Yeah, that is what I wanted to know. What is the dollar values?
Yeah.
Because the percentage becomes very misleading because the numbers are small, but the actual dollar amount actually gives a more clearer picture. The second question I have is that, you had mentioned about the 4% cap rate. So I have a little bit of a struggle with that, and I think Anil mentioned that. So what is your current borrowing cost? So if we were to go to bank and we were to borrow, what is the bank going to charge us for lending the money?
Right now, it's probably around 5%.
So if we are going to be, borrowing something at 5%, how can somebody make money if the cap rate is 4%? Because the cap rate is, cap rate means that, unless you buy something at cash, right, you have to service the debt out of the money or the rent which you're collecting. So do you have a scenario where you can show us where, if the cap rate is, if you have purchased the property at say 4% or 5% cap rate, and with the current rent, again, if we want to be conservative, that the rent growth is not that much going forward, just if we want to be conservative, how would the property service the debt?
So if you look at this here, right here, we are purchasing at 4.3% cap rate.
Okay.
Right. So that's the purchase cap rate. We are borrowing at 4.5%.
Okay.
Okay. But with our operations, we are able to produce this level of, you can see the returns there, right? Like, you can see there, it's going higher. Basically, this is what we are able to produce. So this is what you need to understand. Like, I think when we optimize things, the deal can actually produce this type of cap rate at the asset level.
Yeah, but this is
what I was talking
because
about.
You are able to increase the rent, right? So the market in the last 2-3 years have been really favorable for the rent growth.
Right, that's correct.
So I'm just envisioning a situation if the market is not favorable, then in that situation, what happens? Because that is where, basically I'm trying to do the risk mitigation. So you have shown us a good case scenario, and I want to envision a bad case scenario, that in a bad case scenario, what would things look like? Because, we don't know whether going forward would be a good case scenario or an okay case scenario or a bad case scenario.
Right. Which is what I was showing. The worst case scenario is the reverse. This is the worst case scenario, the blue line. Your returns can go as low as 39% from 120%.
Okay. So you don't have anything in between, like you have 5.2%.
No, we can.
Yeah.
We can. It's just a modeling. We just picked some of this. We were looking at more realistic possibilities when we underwrote this. And then like, this is where we went, like we took a 5.2 and then we kept showing like more realistic scenarios are between 4 and 5.
The reason I'm saying is that, when the lending rate is very low, the market cap rate has to go down, right? Because the money is cheap. You are getting cheap money. So that is why everybody is asking you to pay a higher price. But when the money becomes tight and the cost of borrowing becomes more, then the cap rate also have to go up, because only then the next buyer will be able to make some money.
Yes, that is correct, which is what I was saying. Like, if a situation like this arises, the bottom thing, then we hold on to the asset and then see, like, to look for a favorable condition to exit. But again, this is where I was explaining earlier, the cap, like, I think Jijo has a slide, actually, it shows the prediction.
Yeah, so Kamal, can I just add one more data point to address Davinder's question? So can you go back to the Dscr, the Excel spreadsheet, the previous slide? Yeah. So right here, Davinder, if you look at that green color, you're bringing up some good points, and lenders are also equally worried about this, right? The lenders, they look at the Dscr stands for debt service coverage ratio, right? And it is 1.11. What that really means is, so you look at that same row right now, the debt service coverage ratio is 1.04 when we are buying, right? And then we are improving that. And if it is lesser than a certain level, lender will not even fund this project.
Yeah.
So your concern is very valid, right? But at the same time, see, look at who is investing, right? The bridge agencies are putting their 80% non-recourse loan. So they are equally worried or even more worried than us, right?
Yeah.
So yeah. So the point is that, again, we go for that conservative underwriting. We go to the extreme worst case scenario. And again, right? Things can change, but we look at the historical data. So for example, right, in the market of Texas, we have good slides that explains what happened in 2007, right? The recession happened. What is the lowest level possible in a normal scenario? And that is what Kamal was talking about, the worst case scenario. So our first priority is preservation of capital. Is that so? Look at that cap rate sensitive analysis. 39% it will go down, the worst case scenario, but still you are preserving your capital. The lender is preserving their capital. You are still making money, 39%, in addition to all the tax benefits and all that. It's kind of worst case scenario. So it's all about a conservative nature of underwriting, right? How much conservative you want to be.
No, that's good, Jijo. And one other question I have is that, do you have any project in mind? Because in my mind, the success of the next project will be very crucial in terms of, what improvements can result in increasing the rent increase, right? Because if you are able to create value addition, you will be creating a safety net. If everything is already baked in and the room of increasing the rent or keeping the tenants in there is low, then the project will have more risk. So do you have any projects which you are working on? Because that would be helpful for us, at least that information to make the decision from our team.
That's what it is. When we are working on those, as soon as it's ready, it will be presented in this fashion.
Great.
Yeah.
Kamal, isn't it that you're working on two projects, one in Florida and one in Texas that you're working, and probably it is coming soon? That is where we wanted to be prepared to get in. And as soon as you will be, knowing about it, you will come back to us, right?
That's correct. Yeah. As soon as it's ready, we have it under contract, we'll come to you. Yeah.
And what is the target price for those projects? So that we know how much capital we need to consider on our side.
Our deals are typically somewhere between $20 to $50 million total purchase price. That's the deal size that we look at, in which we raise somewhere between 25 to 30% of it in terms of capital.
Okay, thank you.
Okay.
All right.
Sounds good. I think
it's good. Yeah. Anybody has any more questions? Okay, Kamal, what's the timeline we can look for I know I'm repeating the question. What's the timeline we're looking for the next project? Ballpark?
it's probably in about a month or so is what we're trying to get something under contract.
So let's assume I'm trying to draw a timeline. In the month you get a project under contract and your due diligence starts, right?
Correct.
So you start your due diligence. What's the time needed from that point to raise that capital? So if I have to give cash call to all the team, what is the timeline I'm looking at?
For that, so the due diligence will take about 2 weeks. Within 2 weeks, we'll complete. And then after that, we'll open a subscription. And typically, we have about a month to raise the capital.
Okay.
And then, we wait for the lending process, which will take probably an additional month to finish the whole thing.
Actually, there is a slide at the end, I believe, with a.
Yeah, that's what I think I walked through earlier.
Yeah. This one, right? So if you look at
2 months.
Yeah, 2 months.
2 months is a good, 60 days, yes. From the PSA execution, that the purchase sale agreement, all the way. So this is a real time example, right? Meaning we started on the PSA was signed on 4/30th. We conducted the webinar on 5/25, and then the whole capital raise and everything, the whole process completed, and we closed it on 6/29, I think, little bit plus or minus.
I think the first week we closed it in early July, basically.
Yeah, early July, yeah.
So in this case, in next project case, are you going to do the webinar or the discussion after the due diligence is done, or did I hear it before due diligence?
It's always after due diligence, because we don't know, if we find, otherwise we don't know the business plan, right?
Okay. Gotcha.
Yeah, because we need to know what's the cost involved, what kind of stuff that we need to spend. Are there any major issues? There could be some major issues, and we'll walk away. We lose some little bit of money, which is fine. So we'll walk away and move on to the next one.
Okay. And if on my assumption, or if Santosh has a question. Santosh, you want to go ahead?
It's not a question. What we were saying is that whenever next project is coming, I believe you will give us the first chance for us to, if it is one project we want to do exclusive with you, you are ready for it, right?
Yeah, we are. So what we will do in this case, what we are planning to do is, instead of doing the webinar for everybody, we will do an exclusive webinar first for you, right? And then if that is good enough, then we'll stop right there. We'll not even go beyond that. That's what we'll do.
Okay.
Yeah.
Got you. But so, and going further on that question, so do we expect a project, because do we expect a project in the range of 20 million or a 50 million? Because 30% of that's going to be huge for the raising as well. It's a big difference.
Right. Both the properties, they're probably around higher to around $30 million, let's say. That's where I think we're targeting. Right now.
30. So we need, go ahead.
I would say probably around 30, 35, right? Come on. Yeah.
Yeah.
Okay. So 30 into 30, we need to raise around about $10 million. Am I right?
Correct. Yeah.
Okay.
So 80% of it.
Correct.
Plus
including closing costs and everything, it's about 25 to 30% is what we should be ready with. Sometimes we might get, like this particular one, we had to raise very little because we took a very high leverage, 85% leverage. But this is an exception. We don't do this. There's such low raise. Yeah, it's better to have like a healthy down payment.
Okay, perfect.
Okay.
Super.
So roughly about 20% we should be ready with.
Correct.